When you approach the process of trading, it's very common to make mistakes, and in fact people learn from mistakes. It's all a question about how you bounce back. Let's catch up now with Ron William from RW Advisory, who's been doing a lot of work with the behavioural side of trading. Good to talk to you again, Ron.
Thank you.
First of all, let's identify just what a mistake is in your book.
Yes, well, the textbook definition is a misguided act or judgment. And in life, we make mistakes all the time, perhaps more so in trading and investing because it is such a challenging environment to develop oneself.
What drives mistakes then? I mean, last year we had a big difference in the top to the bottom of the volatility, for example, which presumably gave us a lot of scope for making mistakes in these markets.
Yes, well, I mean, volatility is a big one. It changes the market cycle, but it also changes the very mindset that we have when we're trading the markets. We can see there in 2018, we had the two big spikes, Q1 volatility margin call, which led to the flash crash in Feb. And then in Q4, we had what I've been calling the top of the pops, rest in peace, all the momentum tech stocks, which fell out of grace. Now, the key message here is that there are no certainties in the markets, only probabilities, and any kind of trading or investment mindset needs to be adaptable to that reality. And ultimately, Warren Buffett says it quite brilliantly, really, in his quote, only when the tide goes out do we discover who's been swimming naked. And so I think this has been the ongoing question since those spikes and into this new year and ahead. How many of us are making naked mistakes in the market that could cost us that trade?
Yeah, in the bottom right-hand corner, present, past and future. As I said, it's about how you deal with these mistakes. What about the common trading mistakes that you teach people about when looking at the process of trading the markets?
Well, one of the key things on the recovery of mistakes in terms of past, present and future, it's a quick word on that, is that it's important to build up the muscle for recovering from a mistake and to learn from the past mistake, be in the present of the action. What do we learn from that mistake? And ultimately to better prepare for the future and not drag the past into the future, which is what a lot of traders that I work with do, and that tends to hold them back. So this power of now thinking is quite key.
Yeah, so to the common mistakes that you come across.
Yeah, so just across the board, if we were to list them, number one is actually being too emotional. That's the top of the agenda in terms of behavioural mistakes. There are different types of trading mistakes. There's behavioural, strategy, and risk and money management ones. So the first one is clearly behaviourally linked, and that's just basically too much of the fear and the greed emotions amplified with the money. That tends to create a lot of issues for a lot of people. Second point is not trading, not having a trading plan. Not having a plan is a plan to fail, as the old saying goes, and that's very true in trading. You need a forward guidance, just to plan for various scenarios in the market. And third, over-dependence on externals. So following a trading guru or an automated trading system might be useful based on let's say, hopefully a good track record that they may have, but at the same time it needs to be filtered through our own light of research, just in case that if something goes wrong, we've got some kind of tangible way of referencing that system. For excessive losses, this is unfortunately a reality. No one likes losing money, but it does happen, and often there can be a long and quite upsetting route of trading losses. It's important that we are very clear on the risk that we trade and not to over leverage with that risk. And then last but not least, we need to make sure that we're allocating a reasonable small amount of our capital so that we have enough to stay in the game long enough to be successful.
So what about the behavioural mistakes then when bringing in the psychology around this? How should we approach that?
Yes, well, it all comes back to psychology, and the first behavioral trading mistake is anchoring, and a lot of academia will know this as part of the behavioral finance explanation for our cognitive biases. Anchoring, the best example of that is this whole idea of value. We find value, especially value investors out there, and we anchor on it no matter what the price action does, if it goes wildly up or down, and we just keep on kind of beating the drum about, well, it's good value. We saved $9, as this example shows shows here in the cartoon. But let's go back to Buffett for some words of wisdom. He's always said, and let's not forget, he's a value investor. That's how he's made his money. And yet he says price is what you pay, value is what you get. So don't ever forget that price is the fact. It's the final judge and jury that tells us how our performance or value may have fared. And just on the last point there, of course, anchoring happens not just on price, but also on external news. And so we need to listen to the news, central bank policy, presidential addresses, but let's also filter out the noise from the news, and again, circle back to the price fact, which ultimately dictates our portfolio.
Yeah. I want to move on to the next slide that you got for your behavioural mistakes. And this is the mental accounting. You referenced your poor money management in your second slide, but this is the mental side of accounting. What do you consider to be important there?
I mean, this is us doing our personal accounts in real-time trading mode. and while it's probably good practice to do that, we mustn't mix the two together. So here's an example on the S&P 500, looking at the Q1 top this year in that bear market rally situation. So let's say people were looking to go short as the market was rolling over from those prior highs. What we mustn't do, and what is a worst mistake scenario, is to readjust the stop in order to save money. So this is where we actually engineer the amount of money it costs to put that stop loss in. And instead of having a wide, generous stop just in case the market spikes through, we reduce it in order to save some money. So here what we should be doing is focusing on what works best for the strategy. Treat the stop as a pain threshold, not as a cost-saving idea. And if we do want to save money, reduce the amount of risk on the actual trade. So instead of trading with 2%, trade with 1%, for example. That way you've halved the risk value, but you still have enough room to maneuver just in case the market spikes either way.
And is there a risk here in this setup where you become overconfident?
Yes, of course. Well, that's in our next focus. Overconfidence is a big issue, but I'd say it's more of an issue with knowledge specialists, and many of us can suffer from this. I mean, I had this concern some years ago, and the more that I learned, the more that I thought I knew. When in actual fact, I realized it was the exact opposite. So this picturesque idea of this super mouse here trying to win the cheese or the profit from the mousetrap is a nice analogy to keep in mind. That helmet is a crown of knowledge, giving that overconfidence feeling that it can do as it wills without being harmed by the mousetrap. And this is what we do so regularly in the market, and we must be aware that knowledge alone is not power. It's actually the applied knowledge which is more important. So that experience of actionable, evidence-based strategy work that we know to be true, that matters more.
Give us an example of this.
Well, I mean, it's basically those that feel that they know as much as they do tend to go in overconfident in the market based on knowledge that they may have built up over the years, or profits that they may have made. And so it's either one of the two, knowledge or profits, triggers that overconfidence, which ultimately leads to big behavioral mistakes.
And the herd behavior here, as we got up in the chart, next chart, we're talking here presumably about the sheer numbers of people in a trade.
Yes, I mean, crowding. Let's forget that the heart of behavioral technical analysis and behavioral finance is this idea of a crowd. Think of a herd running in the savannah somewhere. We're observing the herd moving. Now, it's good to study the pattern, trade the pattern, but let's not become the pattern and get hit by the herd. And this is what happened not only in famous trades like the cryptocurrency in 2017, which has now since topped, and we're looking to see what happens thereafter in the long term, but also in famous stocks like Apple, which we all know and love. Let's not get mixed up between brand love and blind love. And so, as in life, love is okay, it's natural human instinct, but the issue is when we get blinded by that love, we marry ourselves to that stock or to that market, and we get blinded by the risks. And Apple's a case in point. Sorry to use this because I know so many people are still long-term invested in this, and they really buy into the brand. But let's also keep in mind that tactical overlays help us not losing more than we should. The market has drawn down 40%, broken below its 200-moving average, and on a basic trend regression, it's below its 7-year mean. So this might be a buying opportunity, since the bounce back we've had. Time will tell, but the most important thing is to apply tactical overlays so that we can get in and get out and make more profit on what we think is a long-term investment.
On the flip side to that, if you're making a loss, it's interesting as well how mentally you set yourself up. If you make a loss, it always seems a lot more painful than the enjoyment you get out of making a profit in the other when the chart's in the other direction.
So this is what science has now proven time and time again, that the pain is just a much greater emotion than pleasure, and the pain-pleasure reaction sensory mechanism in the human mind. So pain of a loss is twice as great as the pleasure of an equal gain, and that's what this chart here shows. You can see the red box there, twice the size of the green one, and so that literally just shows you visually the difference between the two. Now, the pain side of the brain actually triggers our fight or flight reaction. So that lizard brain that some people know about the market, it's what's kept us alive all these years since the caveman days. Nowadays, it's not the saber-toothed tiger. It's the stresses of trading or anything else that can trigger it. But on the pleasure side, let's keep in mind that pleasure also triggers dopamine. So it gives us that kind of that happy chemical in the body. It might be a good idea to profit take on the back of that one point so we don't get too greedy on the profit side. So pain, pleasure, pain is greater, but let's also have both in check.
Okay, going back to the mistakes, what are the solutions then that you like to set traders up with?
Well, the three golden solutions, just to keep it simple and clear. The first one is to actually be aware of our mistakes. So awareness is always key. Without awareness, we can't really do anything else. And so this is an example mistake analysis template as depicted by a leading trading psychologist, Dr. Van Tharp. He actually says, make a list of everything that can go wrong and determine how you will respond to that situation. That will be the key to your success, knowing how to respond to the unexpected. So this idea of responsibility. And in that mistake analysis table, so we have in the first column what the mistake is: emotional entry, tight stop, not following a trading plan, what the reason was: poor mindset, loss aversion, lack of discipline. Count the number of times you've done it, and then work out what he calculates as the R multiple. So that's the dollar amount that is risked for each trade. Work out tangibly in monetary terms how much that mistake cost you on your trade performance, and that way you can actually quantify it and try and reduce those mistakes and more than likely increase your performance. The very last thing I would say is a trading journal, if you want to keep it more simple and less sophisticated, is another way of doing the same thing that I just said. Just write down those trades, but actually most importantly write down the mistakes and the emotional reasons behind them.
Okay, so moving through from that, I'm also interested in the subconscious and the conscious split that we've got, because a lot goes on in our brains that we don't realize actually affects our decision-making process.
Well, yes, I mean, going through the awareness of the laundry list of mistakes that we make day in, day out is step one, but step two is actually that much harder. Now that we know what we're doing wrong, how do we actually bring about real change? And that only really comes by understanding the real source of those mistakes. And that's really best illustrated in this iceberg metaphor that we've spoken about before, this 80-20 rule. Logical reasons for our trading mistakes is only the tip of the iceberg, and the majority of our subconscious reasoning behind that decision-making process is really below the water, and that's more our beliefs and our values, and how both of those relate to trading, risk, and money.
Okay, so let's wrap it all up then and take a look at a conclusion and your proposal.
Well, ultimately, we need to bring it back to being in a peak state of mind, body, and emotional balance. And we've spoken about this on previous segment on trade psychology, but just to bring it back to that, because that still stays true. Let's, on the mind side, remember that our mind is a muscle. And lots of neuroscience is now showing that we either use it or lose it. We can actually train our mind, upgrade the program in order to perform much better. Performance side, we need to keep in mind that our body, diet, and just general calming exercises do matter. If we're feeling strong and energetic, we're better focused at the desk, and if we're eating lots of bad food, that's probably going to change our mood when we're trading, and also in how we react to those mistakes. And last but not least, emotional balance is this idea of coherence. When we're actually in a balanced emotional state, we're much better at recognizing those mistakes, reacting to those mistakes, but also in being able to see the trade opportunities. So for that, I'd recommend a holistic system of mind, body, and emotional balance.
Ron, we've got to leave it there, but thanks indeed for joining us with a look at trading mistakes and how we deal with them. That's Ron William from RW Advisory.